Ladies and gentlemen, please give the warmest Philadelphia welcome to Raj Date.
Thank you. Thank you. First, I'd like to thank David Eisner for hosting us in this amazing facility. It really is astonishing, and I feel privileged to be here. And thank you, Mayor Nutter, for that introduction, but also for all the work that you do on behalf of the people of Philadelphia. You know, the last time I saw Mayor Nutter was on television as he was preparing his city for the arrival of Hurricane Irene, and due to a lot of planning by the mayor and a little bit of luck, the city was spared the worst of that storm anyway. But today, as the mayor pointed out, is exactly 3 years after Lehman Brothers filed for bankruptcy, and it's a useful reminder that not all disasters are natural disasters. Some disasters are man-made, but whether they're made by nature or by humans, disasters are tough to live through and difficult to clean up. Yeah, the failure of Lehman was the largest bankruptcy filing in the history of the nation. And I remember it as very much being one of the most dramatic events in the course of the financial crisis. And I remember very well just how dangerous those days were and how very close we were to real financial collapse. Now, 3 years later, most banks have returned to profitability. And from the point of view of the long-term financial health of the country, that is a very good thing. But as the mayor just pointed out, we all know that families have not been quite so lucky. Economic pain continues for far too many Americans. 3 years after Lehman, unemployment hovers at around 9% nationally, and it's just a touch lower here in Philadelphia. Africans and African Americans and Latinos have felt an impact that is even more serious than the nation as a whole. And together, Americans have lost trillions of dollars in hard-earned savings. And with nearly 13% of mortgages today either being delinquent or in the process of foreclosure, that means that every single one of us probably know people who are in real danger of losing their homes. So anniversaries, even unhappy anniversaries like this one, give us a chance to look backwards, but also forwards. We should look back to remember how it is that the financial crisis actually happened in the first place. And we should look ahead to make sure that we're heeding the lessons that we have learned. You know, prior to the crisis, no single agency had effective tools to regulate and oversee the whole consumer finance market. And consumer protection was not really anybody's top priority in finance. And the result was a system where no one was sufficiently accountable for getting the job done. At the Consumer Financial Protection Bureau, we've been given that important responsibility. The Consumer Agency was established last year when President Obama signed into law the Dodd-Frank Wall Street Reform and Consumer Protection Act. We are the first agency accountable for making sure that consumer finance markets work for American families. To carry out that mission, the law gives us a wide range of tools, from supervision to rulemaking to research to financial education to enforcement to the ability to take and handle consumer complaints. Our work, if we do it well, will benefit the entire economy. We'll give families the confidence that they need to borrow for a home or for a child's education. We'll give the nation's financial institutions the confidence they need to innovate and to compete. And if we get this right, if we do our work right, the Bureau will support the work of rebuilding the economy. And will promote a better financial future for every single one of us. The Consumer Bureau officially opened for business July 21st of this year. It was 55 days ago. The Wall Street Reform Act requires us to tackle some tough problems with tough deadlines. And in particular, in the first stages of the Bureau's life, the law lays out a specific agenda in a specific market, the U.S. residential mortgage market. And that makes sense. First, the mortgage market is enormous. At some $10.4 trillion, it is more than 10 times the size of the next biggest consumer lending market. And it's some double the size of the entire consumer deposit market put together. And almost everyone agrees that the mortgage market, while not the only problem, was at the epicenter of the global financial crisis. The simple truth is that we got into this mess one lousy mortgage at a time. Fixing a market that is so big and so broken is going to take a lot of work. But that's why I'm glad that we've hit the ground running at the CFPB. For starters, we're working to ensure that borrowers can understand what they're signing up for. Most Americans want to own homes, and most Americans need to borrow to make that happen. And most Americans, unfortunately, don't have any realistic chance of reading, much less understanding, the giant stack of legalese that they get in the mortgage process. That's why we're working hard to streamline mortgage forms into short, readable documents. We call it our Know Before You Owe project. And so far, I'm happy to say, we're off to a great start. More than 10,000 community bankers, mortgage brokers, consumer advocates, and just regular interested American families have logged on to our website, which is consumerfinance.gov, to give us our feedback on the draft forms over time. Just this week, we launched our 4th round of public testing, this time focused on comparison shopping. The ideas and the concerns that we have heard through this open process, that's tested our assumptions, and it's helped us to create it's going to help us create a better mortgage disclosure document over time. Beyond disclosure, we want to establish some common sense safeguards to prevent bad practices from harming consumers. That's why we're developing new rules to help borrowers get loans that make sense for them, loans that they can reasonably expect to repay. And that's why we're also working with other federal agencies to develop some basic standards for mortgage servicing. Sometimes ordinary, responsible people deal with difficult financial times. People lose jobs, people get sick, people have to care for loved ones, and they fall behind. And when that happens, it's simply not acceptable to cut corners. The law still applies. Finally, rules only work if everyone follows them, and that requires consistent supervision and smart enforcement. Borrowers don't necessarily know, nor should they especially care, whether their lender is a bank, a credit union, a thrift, a finance company, an investment bank. For consumers, a mortgage is a mortgage, and a mortgage lender is a mortgage lender, and the rules should apply to all mortgages and all mortgage lenders. Unfortunately, for a long time, in practical terms, they didn't. And without a level playing field, even honest businesses can feel pressured to lower their standards to avoid losing market share or losing money. So fortunately, Congress gave the Bureau the authority to regulate and oversee both the big banks and the key non-banks in the business. This will create competition that benefits both consumers and responsible lenders. So you can see that while our actual work to fix the mortgage markets will be quite complicated, the basic themes are pretty simple. Number one, people should be able to know before they owe. More paperwork doesn't mean better disclosure. Number two, common sense rules can prevent bad practices, and they can prevent bad practices from really visiting consumer harm. And then number three, the rules of the road should apply to everyone, and they should be consistently monitored and enforced. Those lessons that I've outlined are not unique to the mortgage market, though. Those lessons can be applied to other consumer financial markets that the Bureau regulates. We've assembled a great team at the Bureau with the analytical talent to make fact-based decisions on how to prioritize our efforts. As in the mortgage market, our work in these other markets will be targeted toward product transparency, towards common sense rules of the road, consistent oversight, smart enforcement. Today, I'd like to focus on 3 consumer finance markets outside of mortgage that impact a lot of Americans: credit cards, student lending, and checking accounts. First, let's talk about something that I bet most of us have in our pockets right now, credit cards. Although mortgage balances dwarf credit card balances, there are actually more consumers with a credit card than with a mortgage. And just last year, Americans opened more than 40 million new credit card accounts. The CARD Act, which was signed into law more than 2 years ago, addressed some of the worst practices that had infected the credit card market. Before the Card Act, credit cards suffered from problems quite similar to those seen in some of the mortgage market. Low front-end pricing, often hyping so-called fixed rates, obscured the true cost of credit, and then hidden within the fine print were penalty fees and rate resets that made using the card much more costly over time. The early results after the Card Act's implementation show that smart regulation can benefit everyone. For consumers, credit card costs are more transparent and more reliable than before, with less risk of unexpected rate increases or other charges. For credit card issuers, it's easier to compete on price and on value. Now, despite this progress, credit cards remain complicated, with many disparate moving parts. And it's not clear if consumers are truly able to understand and compare between different credit card offers. That's an issue that the Bureau has been focused on over the past year, and one that we'll continue to evaluate. But having good laws on the books, like the Card Act, that's not enough. We need to study their impact and make sure they're being followed. That's why one of the Bureau's most important jobs is to create a smart and effective and credible supervision program. We'll be upfront with financial institutions that we supervise so that there are no surprises. Banks and other firms, I'm quite sure, are going to find that we are eminently fair-minded. But we're tough-minded too. And when we find unjustified practices that cause substantial consumer harm, make no mistake, we will take the necessary action to put an end to them. Student lending is another big consumer finance market, and college education is a crucial part of the American dream. It certainly was a part of my American dream. At the Bureau, we want to make sure that education finance truly helps people obtain opportunities that they otherwise could not. I think, as most American families can attest, after buying a home, paying for a college education is probably the biggest investment that they will ever make. And over the course of the past decade, the cost of attending a four-year public college has increased dramatically. And at the same time, the financial crisis has eroded the wealth that families were counting on to pay for college. So students must rely more on loans now than ever before. Student loans are complicated, and they're difficult to navigate. For months, the Bureau has been hearing from students and from parents, from school counselors, service members, and consumer groups about the difficulties that families face in figuring out how much debt to take on. Because tuition has grown so quickly, they must also find often that in addition to federal student loans, they must take on private student loans to fill the gap. Assessing the full cost of federal loans plus private loans and other aid options can be a big challenge. To enhance transparency, in 2009, the Federal Reserve put in place new disclosure requirements for private student lenders. At the Bureau, we'll monitor those requirements, determine how effective they are, and we'll collaborate with the Department of Education to undertake a comprehensive study of the private student lending market. Our research will begin this fall, and we'll submit our report and recommendations to Congress next year. And all the while, we'll be on the lookout for problems in the student loan market. For example, some lenders might be offering loans that they know students won't realistically ever be able to repay in many cases. In some cases, for-profit institutions may even push their own high-cost private loans and use questionable tactics to recruit our nation's veterans to collect more federal dollars. We owe more to our young people, and especially to those who have risked their lives in the service of our country. If problems in this market warrant action, we're not going to hesitate to use the tools that Congress has given us. Finally, I'd like to talk about checking accounts. Almost 90% of American households have at least one checking account. These accounts provide consumers with real value, and they cost banks real money to deliver. Now, in a functioning market, that would lead to a product that customers pay some transparent price to obtain. But over the past decade, so-called free checking products emerged as one of the fastest growing checking products. With these free checking accounts, much of the cost to the consumers were buried in overdraft fees, and the brunt of those overdraft fees has been borne by a small segment of consumers who may be the most unable to afford the resulting shocks to the family budget. The FDIC conducted a landmark study where they found that 84% of overdraft fees were paid by just 9% of checking account customers. Now, many of the concerns about overdraft practices are being addressed. In 2009, the Federal Reserve stepped in with new rules to make overdrafts more transparent. Since then, some banks have gone even further and eliminated overdrafts on ATM and debit transactions. Other banking regulators have either proposed or issued supervisory guidance governing the banks that they oversee. There's understandable concern about the inconsistency that might result from separate supervision regimes. And we also recognize that there are a variety of products that are targeted at consumers who have short-term cash needs, including products offered outside of the traditional banking sector. The Consumer Bureau has the capacity to address this range of products in an even-handed way. Going forward, the Bureau will carefully assess how we can best ensure that the overall market for those short-term credit products is fair and transparent and competitive. We'll be monitoring the impact of the recent regulatory and supervisory interventions, and if we find that those interventions are not working as intended, we will adjust. And if we find that additional action is needed, we will act. You know, while the policy areas that I've outlined here today are far-reaching, they're by no means exhaustive. After all, consumer finance is something like a $20 trillion business. It's larger in asset terms than our country's entire annual GDP. The products in the market vary by size and they vary by complexity, as do the players in those markets. So I can't predict today everything that the CFPB will do in the years to come. But I can tell you how we will approach every issue that we work on. First, we are committed to basing our judgments on research and data analysis. We won't shoot from the hip, and we won't reason from ideology, and we won't press a political agenda. Instead, we're going to be fact-based and pragmatic and deliberative. And I'm proud to say that we are building a team that is eminently capable of making good on that promise. We've hired top-notch researchers, lawyers, and market practitioners. Second, once we understand a problem and its causes, we'll be careful to use the right policy levers to address it. As I mentioned earlier, we have a wide range of tools at our disposal at the Bureau, and we'll strive to use each of them in the smartest way possible, matching policy solutions to policy problems. And we'll use all of our tools in ways that enhance the others. So, for example, smart supervision practices will lead to well-chosen enforcement actions, and both of those will inform a sensible rulemaking agenda. Finally, and most importantly in some ways, we'll tackle our mission knowing that we are singularly accountable for it. Consumer protection in financial services is hard, and Congress recognized that if you don't make someone singularly accountable for doing a hard job, then you shouldn't expect it to get done well. You can count on us to make sure that consumer finance markets actually work for families, for the honest firms that serve them, and for the economy as a whole. Because 3 years after Lehman, we know that there are some mistakes that we cannot afford to make again. Thank you.